This is the Saturday stock market news roundup for Saturday, July 11th, 2026. There's going to be 3 dates that are absolutely going to be moving your money in the stock market this month. And lingering in the background is still this tension in the Middle East that just got a bit more dicey. Yesterday, though, Meta finally saw a surge in price which lifted many of our ETFs, so thank you, Meta. That has been frustrating for a lot of people, and I know because I work with a lot of people on their portfolios and working one-on-one in consultations. So I'm sure a lot of you are very happy, and Meta's a huge part of a lot of the ETFs we all invest in. Things like QQQM and SCHG and just the S&P 500 or total US stock market. So here's 3 quick reasons why Meta is doing well right now. Meta's cost to build AI capacity is tracking closer to $22 billion per gigawatt rather than the $45 billion Wall Street feared. There's also positive momentum, which remains from earlier announcements that Meta plans to launch an internal Meta Compute cloud arm to rent out spare compute power and sell access to its AI models, turning a feared cost center into a direct revenue stream. And one of the biggest pieces of news is Meta's rollout of the Muse Spark 1.1 model and developer APIs, which gives the company a competitive commercial AI product, further boosting investor confidence. We'll see what happens here with that company. Now, for the last 2 years, it felt like only 7 stocks were carrying the entire market, but now we're seeing banks, industrials, healthcare, utilities, and small cap companies join the rally. Historically, that's been a sign of a great bull market that's about to happen. It means that investors are gaining confidence in the broader economy. This is very, very important because it's not just AI. And so that whole idea of AI bubble or AI is the only thing holding the stock market up is starting to diminish. Let's dive deeper. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Remember that all investing carries risks, so do your own research. This is not financial advice, and I'm not a financial advisor. Let me start with the big 3 dates that are coming up in July. These are going to be dates that you're going to want to circle on your calendar. You're definitely going to want to pay attention specifically to these 3. This isn't just next quarter. This isn't just some day. This is specifically in the next 14 days. If you miss them, you're not going to really understand because there's going to be a lot of volatility in the stock market. One day you're going to wake up and it's going to be up. One day it's going to be down. It just depends on, and it depends entirely on some of the decisions that are going to be made and some of the huge breaking news that might come out. So number 1, definitely circle this date, July 14th, and this has to do with the Fed. Very, very important. That's when the June inflation report drops, and for the first time in years, the question's not whether the Fed cuts rates, it's whether they hike rates. Inflation hit 4.2% in May, the hottest since 2023. The new Fed chair, Kevin Warsh, is a hawk, and he's not hiding it. The market is now pricing a 77% chance of a rate hike by year end. That is absolutely huge, and that will be very detrimental to the stock market. If rates go up, that's rarely ever a good thing in the stock market, especially in the short term. Higher rates squeeze growth stocks, push up bond yields, and reprice everything you own. The other thing is that we're starting to kind of price this in parts of the market. And so what that means is that if it is a hot number and if they're talking about rate hikes, that will probably push the stock market down further. But if they say the rates are going to stay steady or even give guidance that they might still have cuts down the road, that's actually going to make the stock market soar. And so either way, July 14th is a very important time for you to put on your calendar. The next thing to be aware of is earnings season, specifically July 14th through 16th. July 14th, the big banks go first. JP Morgan, Goldman, Bank of America, Wells Fargo, Citi. Banks are your read on the real economy. Is the consumer borrowing or is the consumer cracking? Then July 16th, the one that matters most for the AI trade is Taiwan Semiconductor. TSM builds the chips for the entire boom. If it guides strong, the AI trade lives. Netflix and United Health also report the same day. This week basically tells you, is the rally that's happening right now or that we might see in the near future actually happening because of earnings, or is it just hype and hope? Number 3 is all about the AI CapEx question, and this is a $1 trillion question. The 4 biggest tech giants are spending $750 billion on AI this year. Next year, it crosses $1 trillion. The debate, is it worth it? Because the market can't make up its mind. In a single week, chips dropped 4.5%, then bounced 3% right back. Meanwhile, Micron just committed $250 billion to US plants. SK Hynix's US listing that happened on Friday was 7 times oversubscribed. This is the fault line of the whole market. If that spending pays off, the leaders keep winning. If it's a bubble, this is exactly where the crash starts. Every big swing in the portfolio really points back to that question. Is the AI CapEx that they're spending so much on actually worth it? But here's the thing that's tying everything together. Oil. The Middle East tension that's happening right now and has been going on spiked oil. Oil then spiked inflation. And inflation is what's forcing the Fed's hand, like I was talking about the rate hikes from before. If crude keeps falling, the pressure eases and everything breathes. If it spikes again, all three of these turn bearish at once. Watch the price of oil like it's a stock you own. Now, one thing though that is very positive and actually very bullish in the stock market right now is that market breadth is improving. I started with this in this video, but let me explain, because this is probably the most important thing, especially for all of you long-term investors. This has also been called the Great Rotation, which I've been talking about for quite some time. A broader rally is generally more healthy than just a rally by a couple of individual companies. Like I said, it suggests that investors have a much more positive outlook on the entire economy rather than just betting on one or two companies. This usually leads to a much more sustainable bull market. This could be the beginning of a 7 to 10 year bull market if everything goes according to plan. But why are investors rotating? Number one, it's because valuations were overstretched. Many AI leaders have delivered incredible returns, but those gains have pushed valuations much higher. Some investors are asking, where can I find the next wave of growth? That's led them towards sectors that haven't appreciated nearly as much. Number two, earnings growth is spreading. Early in the AI boom, earnings growth was concentrated among companies selling AI chips, cloud services, or AI infrastructure. Now more businesses are starting to benefit from AI through productivity gains and improving demand. As earnings improve across a wider range of industries, investors gain confidence that economic growth isn't limited to just the technology sector. Number three, this is the biggest one. Institutional investors are rebalancing. Large pension funds, mutual funds, and asset managers periodically rebalance their portfolios. After many years of strong performance from the mega cap, specifically technology sector, they're starting to know that the rubber's going to meet the road at some point, and that means that things are going to stall for a little bit. We can't expect 1,000% gain every year from these types of companies, and so they're taking their profits from things and starting to rotate it into things that are a bit more sustainable long term. To manage risk, they often trim positions in their biggest winners and reinvest those proceeds into sectors that have lagged. This is starting to create steady buying pressure in other places than just technology, which is why we're starting to see that market breadth growth. Here are some signs that investors are watching. Analysts often look for evidence that market participation is broadening, such as more stocks making new 52-week highs, equal weight indexes outperforming market cap weight indexes, small cap and mid cap indexes gaining strength, cyclical sectors like industrials, financials, materials outperforming defensive sectors, and advances outnumbering declines on most trading days. These indicators suggest that buying interest is spreading beyond the largest companies. All that is so important, and as I mentioned at the beginning of this video, one other thing happening in the background that is definitely kind of the deciding factor on what happens, especially to inflation here in America and across the world, honestly, and usually inflation then points to what the heck is going to happen in the stock market. This is the tension recently in the Middle East. The situation's escalated significantly over the past 48 hours. What had been a fragile ceasefire is now at serious risk of collapsing. The biggest concern isn't just the fighting itself, it's whether the conflict disrupts global oil supplies. If the Strait of Hormuz remains open and energy markets stay stable, the stock market can likely absorb the geopolitical risk. But if oil shipments are interrupted, higher inflation could delay Fed rate cuts and create broader market volatility. There's been a bunch of reports that Iran is attacking certain ships and different things through the Strait of Hormuz. There's a lot going on, and it's very hard to tell what's actually happening. But again, if this disrupts oil supply, that's a big issue for us. Now that was a lot for this video, but next week I'll definitely come to you on Saturday and let you know what's happened, what's going on, because a couple of those dates are going to be huge and we're coming down to the wire on some big decisions. The stock market is going to be crazy for sure. July should be very interesting. Go ahead and watch either of these videos to keep you going strong in investing. Remember to keep investing simplified.